I think there is risk related to both. Right now, what we are seeing is more manifestation of the liquidity component at this point. There are some pockets of concern with respect to software disruption by AI, some of the middle market or lower middle market roll-up strategies, like think dentist roll-ups and the debt that went into financing them. But the primary issue currently, the headlines that we are seeing, is more around redemptions and vehicle structures, where you have vehicles that have a mix of assets with different qualities and maybe different liquidity. And the game theory is, if you are an investor in a vehicle, your incentive is to redeem as fast as possible. And that creates a coordination problem, i.e. people don't necessarily like sit around the room and they try to coordinate with each other. But if you see other people coordinate, your worry becomes that if the more liquid or highest quality assets are sold or are paid off to redeem the people who redeem first, then maybe lower quality assets remain in some of these vehicles.
So you mentioned Ali, roll-ups of dental practices. I didn't know that was a thing for private credit. I was skiing last week with 3 dentists were in our group. So you get stuck on a chairlift for 10 minutes with 3 dentists of my age, and they're all talking about retiring. And the way they're retiring is they're selling the practices to these private equity knuckleheads, and it's like a great exit for these people. I didn't know that was a business.
Well, and Bloomberg had a great story about how more and more small businesses resisting private credit because they don't want their employees to get screwed over.
Correct. You like plumbers, electricians, like selling off their businesses. I mean, are you kind of seeing some of this? This is a wild time we're in.
Yeah, so that's not the sector that we are focused in. Our fund is more boutique, focused on asset-backed private credit and essentially consumer credit. So we underwrite other underwriters. But what we are seeing in the broader market is that lower middle market, essentially home services roll up. There are some credit concerns around that, and some of those loans went into BDCs and went into some of the middle market interval.
So that said, when do you think this would be a crisis? When would you be concerned? What would it take for you to get to that point?
Well, I'm already concerned about just the liquidity, because if you look at previous parallels, what we saw in 2006, 2007 was initially liquidity crisis, like you had structured investment vehicles, and then that initially had liquidity problems, and then banks were forced to come buy them out. Citi had to buy essentially its SIV, and then at some point it evolved into a credit crisis. Here, the path is dependent on how bad software is. I'm worried that some of maybe the software exposure is not labeled as software, might sometimes be labeled or categorized as other exposure, and the software exposure might be understated. And the path to crisis is usually you lose liquidity, spreads move wider. Because the spreads are moving wider, it becomes a little bit of self-fulfilling prophecy. So that's the dangerous path, and it could take 1 or 2 years for us to see that level of anxiety materialize.
Explain to us what a BDC is and how that's maybe contributing to some of these challenges.
Sure. BDC or business development companies are a type of 40 Act funds. They are regulated by SEC. Right now what we are seeing is the listed BDCs. Some of them have been distributed to retail. All of the large asset management companies have a version of them, from Blackstone, KKR, Ares. And what you are actually seeing in BDCs is a very good indication of the anxiety that is out there. A lot of these BDCs are trading at a discount to NAV. Which means that what they are implying is large amount of losses. And then if you compare that to where CLOs are trading, and sometimes CLOs hold similar assets to BDCs, it might be one of those instances that retail investors might be ahead of institutional investors, because BDC prices right now are implying that equity in middle market CLOs don't have that much value left.